what we're going to be looking at here are interest-bearing notes, and we're going to be issuing a note here using the effective interest rate method. Now, for example here, Corporation A takes out a loan here on 1/1/20X1 from Corporation B in exchange for a 3-year $100,000 note bearing interest, 10% annual interest rate here, and the market rate of interest on a similar note here is 12% per year here. Because the effective rate of interest of 12%, that's our market rate here, of 12%, is greater than the stated rate of interest of 10% here on the note, or that's what the note has for its interest rate here. The present value of the note is less than the face value. So the note is exchanged at a discount. So what do we mean by this discount here? Now, we're going to be looking at it in terms of this notes payable here by Corporation A here, where they're going to have to pay it back to Corporation B. So, and on the note here, there's a stated rate of interest of 10%, and then we have this effective market rate of interest here of 12%. So what Corporation B could do is they could go out and lend this money here to on the market here at a 12% interest rate, or Corporation A would have to pay 12% here of interest on this note here. But stated rate is 10%, so we have to make up the difference here between this 10% stated rate here and the market rate of 12%. So what in essence is happening here, we're going to have this interest expense here on the note, and it's going to be for, say, the $100,000 face value times the stated rate of 10%. So you're going to have a $10,000 interest expense per year here times 3 years here, so you're going to have $30,000 worth of interest here at the stated rate. Plus, we have to take into account the discounted amount here on this note. So what we mean by this discounted amount here is that we have to discount this note back to its present value at the market rate of interest. And we're going to find out that it's $95,200. And that's the amount of money that Corporation A is going to receive here from Corporation B on this note. Now, the note is going to have to be paid at $100,000 when it matures here at its face value here, but its present value is going to be $95,200, and the difference between those two amounts here is going to be what we call the discount here on this note, and that's going to really represent the interest rate here, that additional interest that we're going to have to pay between that 10% stated rate here and the 12% effective market rate. So let's look at how we'd calculate this this present value here on this note here. So what we would do here is go up and use your financial calculator. In this case, I'm using the Excel function, the present value function. We have two items here that on this note is comprised of the principal amount here and the payment amount here, and we got to discount both of those back here to determine its present value. So for the principal amount, it's $100,000 here, a principal discounted back here for 3 years at the 12% market rate or effective rate of interest here, and its present value would be $71,178. That's that present value of the principal amount here. Again, discounted back at the effective market rate or the of interest here at 12%. Now for the present value of the payments, same thing. We got 3 payments here of $10,000 each, discounted back at the market rate of 12%. Their present value is $24,018. So present value of the note here is just the sum total here. Present value of the principal amount here plus the present value of the payments equals the present value of the note here, $95,200. So that's what Corp B is going to receive on this note when they exchange it here at the beginning of year 1 here, and they're going to have to pay back the $100,000 here at the end of the 3rd year. So the difference between our face value $100,000 and the present value of the note $95,200 is the discount on this notes payable here of $4,800. So this is what we're going to have to amortize, and amortize as our extra interest expense here on this note. Okay, so what we want to do is we want to go down and look at how we'd set up our amortization table here, and this is going to be using the effective interest method here for amortizing this note. So what we have here, we've got this we're going to have our note stated rate of interest of 10% here, and that's going to be the payment amount here. Remember, we talked about that. The payment they're going to have to pay each year here is that $100,000 face value times the stated rate of interest of 10%, and that's $10,000 per year here. So each year they've got that what's stated on the note here is $10,000. Total amount of interest over the 3 years would be $30,000 for those interest payments. Now we've got this effective interest rate here, and this is going to be the actual interest expense that they're going to be paying on this note here. It's going to end up to be what's shown here, $34,800. But they have paid the $30,000 here in those cash payments, but what we have to do is we have to calculate that extra amount here, the difference between the effective interest rate, the total amount here, $34,800 here, and that $30,000 cash payment that they're making. And we do that here by amortizing this note here. So what we do is we start out with our beginning balance here. That's its present value of the note here, $95,200. That's what we calculated up there here, and we amortize it up to its maturity value here of $100,000. And we do that by using this effective interest rate here. So we take our beginning balance of $95,200 here times our effective interest rate here at 12%. That's going to give us $11,424 here of interest expense here for the first period of the end of the first year here on this note. So the payment amount we're going to make is $10,000 here. The interest expense that we're actually going to experience here with with the effective interest rate that we're paying is $11,400. So the difference here is our amortized amount here. It's simply the difference between the $10,000 payment and the $11,424 amount of interest that we're due because of that effective interest rate here of 12% gives us $1,424. So to determine our beginning balance here for the next year here, just add the start out with $95,200 here, add the $1,424 to it, and our new beginning balance for the next year is $96,624 on this note here that we're amortizing. So taking that amount here times the effective interest rate at 12%, for the next period we're going to have an interest expense here, effective interest expense of $11,595. Compare that to the cash payment made at $10,000, so we're going to have to experience this additional interest expense as the difference here, $1,595 beginning. Add that to your beginning balance, you're going to get your new balance, and just continue on amortizing it in that fashion. So what we would off our schedule here, the payments, the actual cash payments that we made were $30,000 here, but the interest that we're going to have to recognize on this note on our income statement with the effective interest of 12% here, or the market rate of 12%, is $34,800. So the difference between the cash and the effective amount here of interest is the amount that we're amortizing here of $4,800. And we did that just by amortizing, beginning with the $95,200 present value of that note, amortizing it up to its maturity value of $100,000. And that's how we go about determining the total interest expense for each period here. So just looking at our numbers here again, you can look at them down here. 95,200 times our 12% effective rate here gives us $11,424 for the effective interest expense for the first period. And then our next beginning balance, you just take the 95,200 here plus the amortized amount for the period, $1,424, gives us your new amount here of $96,624. Okay, so we've got our effective interest method here, and we amortized that extra interest expense that we have to recognize on this note based on the cash payments we're making here and our effective interest rate. So now let's go up and look at how we'd record this here. Okay, so recording the interest-bearing note payable here using this effective interest method here for Corporation A as the borrower. That's what we're going to look at here. So I've got the asset accounts shown here as our cash account here, and then our liability accounts I've set up here as a notes payable, and then we're going to be looking at this discount here, the notes payable, and then on our income statement we're going to have it separated out here as the interest expense for the cash payments plus the interest expense that we're amortizing for that extra interest amount here. So looking at our first, when we issue this note here on 1/1/20X1 here, so we credit, or we set up our notes payable here, credit it on our balance sheet here for $100,000, and then the debit amount here, the cash that we're actually receiving on this notes here, would be $95,200 $95,200 here on 1/1/20x1 here. So we need a balancing entry between the notes payable here of $100,000 and the cash we're receiving of $95,200, and that is what we set up here as a discount to our notes payable, which is a contra account here to the notes payable. So we would, the balancing amount would be that discount that we calculated here, $4,800, and that's simply the difference between the $100,000 maturity value here and the cash that we're receiving here of $95,200. So our $95,200 plus a debit amount plus the debit here to the discount of $4,800, which is our contra account to our notes payable, balances with our credit amount here of $100,000. So what we would do each period here is I've split up this interest expense. Now what we have is that cash payment, and that was of $10,000 each period here at 12/31 X1 here through X3 here, and that was simply the $100,000 face amount times the 10% here stated rate of interest on the note, and that's that $10,000 amount here. So we'd credit or reduce our cash here by $10,000 for each of those periods, and then we'd go over to our income statement here, the interest expense on that 10% stated rate of interest. We would be on a note here, we'd just be debiting that here for $10,000 each period here on our income statement. So now we have to deal with that extra interest here, and that goes against this discount to our notes payable. So remember, we started out with a debit amount here of $4,800, and then we just take it off our amortization schedule. We'd reduce this discount here each period here, each year here. So looking at the end of the first year here, 12/31 X1, remember we had that, we would credit it for $1,424. That's what we amortize, that extra interest expense here. And then we would, the balancing amount, or they would go to the interest expense here in this notes payable I've broke out here, debit that here for $1,424. So each year here, at the end of each year, we just take this off our amortization schedule here. Our discount to notes payable here, that's that extra interest expense. We would credit our discount here in looking at year 2 here was $1,595, year 3 here $1,786, and that's using this effective interest method here for amortization that we calculated. And then that credit here goes against our interest expense here that I broke out here on our income statement for that amortization amount here. You can see it. Debit here, second year $1,595, debit here for the third year $1,786, again at the end of the year here. So what we've done here is, by amortizing this note here, we had to experience that extra interest expense here because the market rate here was greater than the face or stated rate of interest here on the note. So the discount here was recognized as a interest expense here due to that extra amount of interest that we had to pay, and then I've just shown the interest expense here for the cash payment. So we had the cash payment shown here, and then that extra amortized interest amount shown here, both on our income statement here. And then finally, when this note does come mature here, we have to pay it out here at the end of the third year here in 12/31 X3 here. All we do is debit our notes payable, remove it off the books here, and then we'd have to credit or reduce our cash account here by $100,000. So here we had the $100,000 credit amount here in our notes payable at the when we issued it here, and then at the end of the third year here we'd debit it out here for $100,000, and then the balancing or the credit would be going to our cash account, reducing our cash account here by $100,000. So that takes care of this issuing this note here at a discount. Now, we could have gone through here and issued the note at a premium. That's where the market rate would have been less than the stated rate of interest, and then we would actually be reversing this account here. We're not going to get into it, but you'd have to go through looking at a premium here. It would be just the opposite. We'd have to amortize that differently here, but that instead of being at a premium, it wouldn't be a contra account to our notes payable, but it would be an addition to it here. We're not getting into that. We just looked at here at a discount, but that's how you would take care of it when you're dealing with those different interest rates.